Equity Group just announced their third quarter 2025 financial results, and the share price reacted immediately, reaching their all-time high at 67.75 Kenya shillings. So in today's video, we're gonna do an analysis of whether the share price of Equity has fully priced in based on the financial results that they reported, and whether you should invest right now or wait for a pullback so that you can get into the market. We're gonna do a summary of the financial report and also study the dividend trends of Equity. So by the end of the video, you'll have some insights on whether to invest in equity shares or not. And this video is only for educational purpose, so don't take it as a financial advice. And without further ado, let's get started. As you can see from this, Equity share is currently at 67.75 Kenya shillings. And after the announcement of their financial performance, the share price shot up to 64. And currently it's still going up, and it might even reach 70 Kenya shillings. So that is the trend of equity shares. And let's see the dividend yield and also the market capitalization of equity, including the earning per share and price to earning. So the current market capitalization is 250.01 billion Kenya shillings, and the dividend yield is 6.42. Basic earning per share is 15.75, and the price to earning is 4.00. When I checked last on Friday, it was 4.75. So let's now see the dividend history of Equity so that we can see if there is a probability that they'll be paying more dividend next year. And if they announce an increase in dividend payment, just like they did last year, then their share price is likely to go up. And let's now see the dividend payout history of Equity. So the last payment was on 30th June 2025, and they paid a dividend of 4.25 Kenya shillings, the dividend yield being 6.42. So from 2018, they started paying dividend, but in 2019 and 2020, they did not pay any dividend. So we're going to see why they did not pay any dividend in 2019 and 2020. But in 2018, they paid 2 shillings. 2021, they paid 3 shillings. 2022, 4 shillings. 2023, 4 shillings. And 2024, 4.25 Kenya shillings. So that is the annual dividend payment by Equity. Let's now go into the summary of the financial reports that were released on 30th October so that you can understand why the share price of Equity rose. So the profit after tax rose by 32% year on year to 54.1 billion, up from 40.9 billion. So there was an increase in profit, and that really reflected in the share price. The return on average equity reached 26.4%, and return on average asset was 4.1%. And the net interest income grew by 16%. That is the interest they get from the loans they give out to their clients. And the non-funded income grew also by 3%. So from this, we can see positive results, and that is why the share price rose. The cost to income ratio improved, dropping to 50.6 from 55.1%. So if the cost of production reduce, then it means that the profit will be increased. And that is a good indicator also to the share price rising. We also have cost of risk, that is loan loss provisions relative to loans, was also contained at 1.9%. So that is a good indicator too. And let's now go ahead and see the segment and regional performance. As you know, Equity has opened other branches in the East African region. And in Kenya, the profit after tax for Kenya business rose by 51% from 20.6 billion to 31.1 billion Kenya shillings. In terms of regional subsidiaries, in DRC, loan grew by 19%, and in Rwanda, the loans grew by 34%. So with more loans being given out, then the net interest income increases, and that is a good indicator also to the share price rising. And finally, in terms of asset quality, the non-performing loan ratio improved by 12.1% from the previous 13.4%. So if the non-performing loans drop in percentage, that is a good indicator. So non-performing loans are those loans that clients have defaulted. So it's not easy for the bank to make some interest income from it. So if the non-performing loan percentage drop, then that is a good indicator for the company. In addition to that, another positive indicator on the non-performing loan is the coverage of non-performing loan, which was 71.4%. And what does this financial report means to investors and even the share price. The strong growth in earning, efficiency improvement, and regional diversification are a positive signal. It suggests the business is scaling, improving margins, and managing risk better. So by diversifying into other regions like DRC and Rwanda, if in Kenya we make some losses, we may make profit in Rwanda or DRC. And that is the good thing about diversification. So for investors, the higher return on average equity and improvement in cost ratio mean the bank is getting more returns from its equity and also operating more efficiency, which can support higher valuation or future dividend potential. So with this higher return on average equity, meaning that the money from investors, those who put their shares, are being used efficiently, and there is high probability that the equity group will likely increase the amount of dividend they pay to their shareholders because they are getting more income from the investment from its shareholders. And let's now go into our third point here, and that is asset quality improvement, which we have seen. Low non-performing ratio and good coverage reduce one of the major risks for bank stock, that is defaulting and provision. So when we have non-performing loans, then the banks need to make a provision for that so that to cover such non-performing loans. And if the bank is able to reduce the percentage of non-performing loans and also improve the coverage, then that is a good indicator that they are managing their risk well. So that is a good indicator to the share price of that company. And we have seen that reflecting in the share price of equity. After announcing the drop in non-performing loans and also the coverage, the share price responded positively. And from these results, we have already seen that the market has reacted to these results. So we need to ask ourselves whether the market has already priced in fully or not. And if it has not priced in fully, then you can take advantage by purchasing the shares and wait for the market to fully price in. So if equity announce better results by the end of the fourth quarter of this year, there is high probability that the share price of equity will even rise past 70 Kenya shillings. Let's now go back into analyzing why equity didn't pay dividend in 2019 and 2020 despite them making profit. And as you saw earlier, the equity group has been paying dividend increasingly. So there's high probability that they are likely to also increase dividend for next year. But before that, let's see the financial reports of 2019 and 2020. For the year ended 30th December 2019, the board originally proposed a dividend of 2.5 Kenya shillings per share. And you can see that 2.5 was an improvement from 2018, which was 2 shillings per share. So there was an increase in the amount of dividend that they paid. However, in May 2020, the board withdrew the proposed dividend payment of 2019, citing the global economic uncertainties caused by the COVID-19 pandemic and the need to preserve capital. So that is a good move when it comes to managing a business. So there was no need to pay dividend, yet there was a lot of uncertainties in terms of the economy. So as an investor, that is a good reflection of a good company. And for the full year 2020, equity again did not declare or recommend any dividend. Thus, shareholders went without dividend for 2 consecutive years, that is 2019, payout being cancelled and no dividend in 2020. And the same reason for no dividend in 2020 was because of economic uncertainties. And that is a prudent move by the management. And let's see the financial results of 2019. So for 2019, equity reported a net profit after tax of approximately 22.9 billion. The growth in profit for 2019 was 14%. So despite the growth, because of the emerging COVID-19 risk, the board decided to conserve funds rather than pay out. So this is a good move because instead of paying out dividend and then you end up borrowing loan to fund your business, the best option is to retain the earnings. And let's now see the financial results of 2020 and see the reason why also the company did not pay dividend. Profit after tax declined to around 20.1 billion, a drop of 10.9% from 22.6 billion in 2019. So there was a drop in 2020. And that's why they did not announce the dividend payment. And despite the fact that it dropped, they still made some profit. The bank balance sheet expanded significantly. Total assets rose by 50.7% to Kenya shillings 1.015.1 billion, that is 1.015 trillion Kenya shillings. Loan book grew by 30.4% to 477.8 billion. Government security investment grew by 26.8% to 175.7 billion Kenyan shillings. So despite the economic challenges, they still managed to improve their asset value. So that is a good move by the management. So this is one of the companies in Kenya that every investor should keep an eye on. However, the cost of income ratio deteriorated to 77.6% because loan loss provision increased by 402.2% in 2020. So most businesses defaulted in 2020, so there was the need for loan provisions. So that really affected the profits of equity. So that's why there was a drop in the profits of equity, because if there is more defaulting, then the interest income drop, and that is reflected in the drop in profit. The bank noted that for the year 2020, it will again not recommend dividend, citing the need to devote internally generated funds to both defensive and offensive strategies amid the pandemic. So from that, you can now see why the company did not pay dividend in 2019 and 2020. And what does this mean to you as an investor? So the decision to skip dividend in 2019 and 2020 showed the bank prioritized capital preservation over shareholders' payout in a crisis. Also, the decline in profit in 2020, despite strong asset growth, indicates that while growth was robust, risk cost, that is provision and expenses pressure, weighted heavily. So those provisions and expenses were more, and it had an impact on the profits. So from this is a good example of why investors in banking stock need to watch dividend policy, asset quality, and management's willingness to conserve capital when times are tough. Also, this shows that strong growth in lending asset sides does not always translate into immediate shareholders' return if risk and provision rise. So that is one of the other things you should keep an eye on. And finally, let's see whether the share price of equity has priced in fully or not. And we will be looking at one metric, that is price to earning. The trailing price to earning ratio stands at around 4 point something, and from trading view last week it was 4.75. And this metric, price to earning, is used to analyze whether the share has priced in recent news. And for equity, the current price to earning is 4 point something. That is well below the Kenyan market average, which is 6 to 7 point something, and also below the industry average in African for banks. So most of the African banks have the price to earning ranging at 6 point or 7 point something, meaning that equity share price has not priced in fully. So that is the speculation, because equity price to earning is 4 point, which is below the average price to earning of the banking sector in the country and also in Africa. And let's now interpret what price to earning means. So low price to earning can mean the share price is cheap, which means good potential, or that the market is skeptical about the future growth, that is high risk. So the recent surge of equity shares to 66 to even 67 after the results shows that the market is applauding the strong growth of profit, which increased by 32%, and other metrics improvement like the loans they give out in DRC and also Rwanda. And what does this mean on the upside? That is the positive end. If equity continues improving its margins, controlling the non-performing loans, increasing dividends, the share could still go up, or valuation could also expand. So if they manage to maintain the same results of Q3 in Q4, then there is high probability that the share price of equity will also rise. And let's now see the other side, the negative side. If the growth is low, let's say on Q4, and the risk cost arise, that is on the provision and also the non-performing loans, or some regulatory or macro issues which can have a negative impact on this company, then the low price to earning could also contract further, meaning the share price will fall. And this is my final verdict on the share price of equity, whether it has priced in fully or not. For me, I think the share price of equity has more potential to go higher, because I think it has not really priced in fully, because the price to earning is well below the average of the country. And if equity announce more positive results in Q4, because we have not ended the year, there is high probability that the share price of equity will also rise. But always take caution. If you are holding the shares of equity, then monitor the key metrics that I've shared earlier. And if you are thinking of buying equity shares, then you are buying into potential. But be comfortable with the risk of the share price dropping a little bit in case we have negative results in the Q4 of 2025. But if equity announce good results, like in Q3, then the share price is going to rise, and that will be profit for you. So hope you have been able to gain some insight of the performance of equity shares and how to analyze a share when we have some announcement. And let me see you in the next video where we'll be talking more about other shares in the Nairobi Security Exchange market.